Hi, I'm Carsten Lootze from Reuters. Last year has been a pretty weak one for the European ETF industry, which has been used to success. So, is there any light at the end of the tunnel? That's what we'll discuss today with Detlef from Lippe. Detlef, how strong has the European ETF market grown at the beginning of this year?
Well, compared with last year, where we saw a very weak growth rate of 3.71% in overall assets under management, the first quarter of 2012 was marked with quite good growth, as we see it here on the graph. We saw 8.71% in growth in assets under management.
And in which asset classes did the investors go via ETFs?
Well, the main inflows were shown in equity ETFs with roughly 3 billion in new assets under management, followed by bond funds and the commodity funds. And then we saw low inflows in funds from the so-called other strategies and outflows out of money market ETFs.
In the second half of 2011, we've seen pretty few new ETFs. So have the providers been more active again this year so far?
Well, if you look at last year, the number of new launched funds wasn't that low as one would expect due to the rough market conditions and all the discussions going around in the market. But if you look on the first quarter of 2012, you see that there's already 62 new ETFs launched. 31 of these, so the half of them, are in the equity space, 19 in the bond space, 7 are strategy ETFs, put together in the other ETF funds. Then we got 4 commodity ETFs and 1 money market ETF so far.
Why have the providers been more active again? Is there any link to what ESMA, the European regulator, has been published at the end of January? Because then they published final draft rules for a new ETF regulation, and one could say that the providers have more clarity now what kind of regulation they will face.
Well, actually, from my point of view, the ESMA paper had no influence on the market at all. I would say that you rather see more demand from investors for new product ranges. So there's a demand for sector funds in the equity space, but on the other hand side, the inflows in the new launched funds show that there's a strong demand for bond ETFs. As you see, over the first quarter, the majority of assets under management in new launch products went into the bond segment.
And which providers have been the most active ones so far this year?
Well, just by number of funds, the most active providers were Luxor and DBX Tracker, followed by UBS. So Luxor and DBX Trackers are mainly completing their product ranges in terms of sectors or strategies. And with UBS, you see that they are going to build up their product range to come to a competitive level. You see that they had some of the major plain vanilla indices in their offering. They've got gold in addition to that. So they are now going for other indices to have a complete product offering and be competitive with the big players in the market.
But we haven't seen any new products from market leader BlackRock. Why is that?
Well, BlackRock iShares has already a very competitive product range, and they are mainly go for full replication in their ETFs. If you think about the strategies which are demanded by investors at the moment, maybe short for bond special sectors or special countries or regions, you see that these kind of strategies can only be build up by using swaps. So if you don't want to go for derivatives in your replication methodology, you can't do these kind of ETFs.
In May this year, we've seen entering 2 new ETF providers on the European market. Vanguard from the US, which is a very big name there, and Swedbank Robur from Sweden. So do you think that there is still potential for new providers?
Well, of course, there is potential for new providers, especially if you think about Vanguard. Vanguard is one of the mega brands in terms of indexed investments. So, from my point of view, it was rather a question of time than the question if they would come to Europe. And now they did that move. Into Europe. So I think there is space for them, and they will gather assets under management just due to the fact that they are a giant brand. People will look at their product offerings and even invest in their plain vanilla products. They might have a hard time to speed up with the local products from iShares or Deutsche in terms of the plain vanilla indices, but at the end of the day it's successful. On the other hand side, you see Swedbank Robur, which is a very local brand in Sweden. They've got a strong branch coverage in Sweden, so they can provide their funds via their branches to the customers of the bank. Having said this, in Sweden, the banking sector, or the client advice, is going via internet, so people can buy their ETFs on a low-cost basis via the internet. They are used to it.
So all that doesn't sound like a market shakeout, that some experts have been talking about for almost 2 years now.
Well, there was always rumors around that we will see a consolidation of the European ETF market, and that we will see funds getting closed or companies leaving the market. But if you look on the things which have happened, you need to do a very deep analysis. Having said that, we looked on the 1,711 ETFs which are registered for sale in Europe overall to find out, is there anything like a death list, like we know from the US, where some of the market commenters are regularly reporting about their funds. And we found that funds need a proper period to get introduced to the market and to have market participants to get used to these kind of strategies. So with regards to that, under the 3 years period, we've got 542 ETFs in Europe which are older than 3 years. The second point you always hear from the market is that an ETF needs to be at least a size of 100 million euros to be profitable for the fund promoter. If you take these two points in consideration, the 3 years time period and more than 100 million, we have 241 funds left, which might be on a death list. Having said this, one needs to take into account that ETFs are not only having income from management fees, they also generate income from other things like creation and redemption fees, which one needs to take into account if you evaluate the profitability of an ETF. So if you think about strategy ETFs, which are on a leveraged or a short index, they are traded intraday. So there's a huge turnover in these funds, and the fund promoters earn their fees on that and not on the management fee. So having said this, I don't see any demand for a consolidation in the market so far. This might change, even if we see wider product ranges, and we might see tougher times in the markets in general. But so far, the European fund market has no trend towards consolidation.
Detlef, you've mentioned 241 ETFs on the European market that are likely to be delisted or be merged. So does that mean that the ETF product range on the European market will shrink?
Well, as I said before, I don't think so. I rather see a lot of white spots on the landmarks of the ETF providers, especially when you think about the upcoming or possible upcoming market environments, increasing interest rates, maybe some defaults on the market or things like that. So there's a lot of room for ETF strategies or even active indexing, which can be filled with new products. So with regards to that, I don't see that the product offering will decline in Europe, especially when we see new promoters coming to the markets.
You've told us that the assets under management in ETFs on the European market have grown much stronger again at the beginning of this year. So what would you expect for 2012 in a whole and for the coming years?
Well, the ETF industry saw a great growth rate over the past decade. And having said this, the number of assets under management is quite high, and with respect to that, the growth rate will shrink over time. This does not mean that the industry isn't as successful as there was before. It just means that you have a higher assets under management, and any euro which comes across them does not contribute so much growth as it has before. With respect to that, we will also see more impact from market volatility. So if you see that the share of the assets invested in equity is going up, volatility has more impact on the assets under management than it had before. You see this in the last quarter of last year.
So thank you very much, Detlef, for sharing your views with us. This was Detlef Glow from Lippe. My name is Carsten Lootze from Reuters.